Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Joffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.
Hello. Today, the office market has improved. People say leasing is back, the economy is getting a little better. I'm a little worried about that. But I really wanted to bring together people who own, control, and manage the office operations in the tri-state region. My guests today are Scott Reckler, the chairman and the CEO of RXR Realty, Dennis Friedrich, the president and CEO of U.S. operations for Brookfield Office Properties, Mark Portner, the managing director of Capital Markets Group for Shorenstein, and last but never least, my good friend Joseph Moynihan, the chairman, the CEO, and the grand poobah of the Moynihan organization. So Joseph, you've been around the market. Everybody's been around the market a number of years. I think this is like truly your 20th anniversary. You're celebrating
more like 30th.
30th
Yes,
anniversary, but
yes.
20 of major years. How do you see the market? Because as people would say, last year, 2009 was, it's disaster. Every broker was worried they didn't make any money. There wasn't a deal. How's 2010 as we end in the fall of 2010?
Michael, we are working the market. We are working very hard. We know the market is getting better, and we're just not sitting around. And I think with the velocity of about 1.2 a month since January, it has given the market some energy. People are trying their best. The fear of rents going up in 2012 and 2013 is bringing the tenants and landlords on the table to make a blend and extend kind of deal. Today is all about having a good product, having a good proactive team, price to the market. And I think once you have all things in place, I think there are deals to be made. We are very, very happy. I'm very eager and very active these days comparing to everything else that's going on around the real estate business.
Dennis, Brookfield is 74 million square feet or something in North America here. I mean, you have the best, you control the World Financial Center, such a beautiful property. You have other buildings in Lower Manhattan, and then you have a couple of small buildings, like 300 Madison, 245 Park. How do you see it? I mean, looking at your prospectuses and your presentations, you really don't have too much vacancy. But how's the market look to you today?
The market really, our feeling was the switch went off a bit in the early fall of last year. We actually felt that it started to kick in for a number of reasons. I think it was pent-up demand to a certain extent. The jobs situation was not as severe as I think everybody expected. I think if I remember the stat, it's probably 175 lost since then, 175,000 since then. We've had about 12 to 14,000 jobs come back. So as the financial services guys came back to life much quicker than most anticipated, we saw a pretty strong ramp up from the same time last year, and it just continued through 2010. So right now, what we're keeping a close eye on is their resiliency to it. Once again, the New York City economy has shown its resiliency as the real estate market has. We have not seen any let up in Midtown, where we continue to increase effective rents, and we've been very active in Lower Manhattan as well.
Now you have something in Newport. How is that doing?
We do. We acquired that as part of our Trizec acquisition a few years ago. We're over 90% occupied there. It continues to be a good option. It tends to be more of a back office opportunity for some of our existing tenants or some new tenants there. And we've done well. We've been extending tenants there, and been pretty pleased with the activity. Some spillover activity coming out of downtown, interestingly, on the larger scale side.
Now, Scott, I mean, you are like the king of Long Island, Nassau, Suffolk, New Jersey, all over Connecticut. How do you see the different markets? I mean, you're now back in Manhattan. You were always there, then you sold it to SL Green over there. How do you see the suburb market? And then we'll talk about 340 Madison and so on.
I think the suburban market is different than New York City in the sense that you're not seeing that level of rent spike. You've seen activity in the suburban markets, but I think, as Joe may have said, the landlord-tenant mix has shifted. Brokers today in the city are coming and say, let's cut deals because we want to lock in low rents before there's a spike. In the suburban market, you're still at a point where it's more of a tenant's market than a balanced market. Now, they're a little bit more realistic, whereas before they give you any offer and say, accept it. I think now they realize they got to be, more moderate to try to find a deal that will clear. There's also, I think, in the suburban markets, a big difference between the trophy assets and the more commodity-like assets. The trophy assets, you can meet the pricing and stay leased. The commodity assets, there's just so much competition that there's really no clearing price. You just got to keep trying to steal tenants from one of your competitors.
So you came back into the city buying 340 Madison. How do you see the Manhattan market, to buy properties, to look over there? How do you look at this?
We've always been a big believer that in the Manhattan marketplace that you do see those rent spikes. And I think what you've seen historically, when Manhattan comes, the trough to peak always gets higher and it stays. So if you look at the line of performance, it's one that keeps escalating along the way. There's always a new high at the end of the next cycle. And so, our perspective coming back into Manhattan was we're at a point of trough. Let's get in and let's start acquiring because we're going to, over the next 3, 5, 7 years in this cycle, we'll reach another peak again. And that's something that we intend on, being very acquisitive and trying to take advantage of.
You bring up an interesting thing. When do we see the peak again? I mean, I remember when the peak was. I remember these people in 2007. Joe, come on, rents. We had $200 a square foot, at 9 West and other properties over there, 767. People weren't talking about rents of $40 a foot. It was gone. Do we see the peak in 2012, Dennis? Do you see it getting better, Dennis?
I see it continuing to get better. 11 may be a little tempered compared to the spike we have seen in 10. I mean, one thing, interestingly, not to go backwards, I'll go forwards, and Michael, in a minute, is that we actually have seen our net effective rents increase by probably slightly north of 30% from the trough when you looked at true net effective rents at the top end of the market, because concessions have been coming down. We've had a spike. To continue at that pace through 11 may not quite happen while we still have some economic uncertainty.
But I think the 30% is a very interesting fact because, people last year, were getting rents, people were saying, hey, 9 months free, 11 months free, $60
Right.
TI improvement. Now you came in here, I mean, you run the East Coast, acquisitions and everything for Shorenstein. You guys came over here, you have always been here. I mean,
That's right.
You had 450 Lexington Avenue, you had 125, but you went in there and bought a couple of buildings.
We bought some of the Maclo assets in '08, and then when the financing market dried up, which was largely a function of no leasing market, right? Because if you don't know where rents are, it's hard to price equity or debt. We then stepped up and started making mezzanine loans or buying mezzanine loans and tried to fill that gap for a little while there.
You know, certain people, when they do mezzanine loans, you know, it's a loan to own. I
Right.
mean, were you looking to perhaps own these properties?
Well, that's a good question, because at that moment in time, it was more of a loan-to-loan strategy. 650 Madison's a good example. We looked at that asset, we evaluated it when it was for sale. We couldn't buy it. The price was just too high, and the economics didn't make sense to us. So we said, you know, we can get in at a lower basis. The returns actually we thought were better for our equity than actually the equity buyer would receive. And it felt like the right risk-adjusted return. However, we were prepared to own that asset at that new basis over a long period of time. And that may be the difference between what a Shorenstein can do and a traditional lender. Those guys probably don't want to own that asset, and they can't own it with duration and with capital to delever if something goes wrong. Our strategy was to have the capital to be ready to delever that if something went wrong. That's a happy ending. It paid off. So.
You know, it's interesting you talk about 650, because it also relates a little bit, you know, when you own office buildings, you also own the retail underneath. I mean, Joe owns major properties on Fifth Avenue, which has really done well. You know, Fifth Avenue, you
Retail
just
is
got
doing great.
Filene's, you got Filene Sims moving in over there, you got Chase came over there, and, you know, I think across the street at S.O. Green's building, they've just signed a lease over there for the vacant space. So, you know, the retail, and you have all the World Financial Center retail. How do you see that effect now in the retail business?
I think sidewalks are busy. Tourism is great. I think Euro is strong, drives a lot of energy into the sidewalks in Manhattan. I think, in my opinion, is the better segment of the commercial business for New York between office and retail. Retail, I think, is ahead. We don't have any or much vacancy in retail. And as long as the hotels are busy and the airports are busy, I think the retail in Manhattan will do just fine. You mentioned one thing about renting of $200 a square foot. Of course, Michael, there is always a case in any given time, good or bad or in between, that you can rent a piece of space for $200 or something off the chart.
There's always a hedge fund
Always,
who
always,
wants a little
There
boutique.
is al-
you know?
you're totally right. But these are very isolated cases. You cannot fill a building at $200 a foot. Just same as you cannot build a condominium tower and sell it out at $5,000 a square foot. Yes, you might sell a condominium for somebody that falls in love with a unit for $5,000, but you cannot predict those kind of rents and those kind of sellability for the entire envelope of a building.
I think my perspective, at least, is there's a reasonable chance that the demand that's out there today will continue to be a little bit dampened by what's going on with the financial service firms. And you have really two things. One, the financial service firms and all the uncertainty around the Dodd-Frank bill, around Basel III, and, you know, at the end of
And
the
the
day,
capitalization of leases also?
and well, potentially with the
Everything,
FASB ruling,
the
the
FASB
FASB
ruling
ruling,
they're
also,
grappling with
which
much
could be
more.
a big issue. Hopefully they'll come to some resolution, but there's a lot of uncertainty. And, you know, Meredith Whitney came down and said there's 80,000, there's going to be 80,000 job cuts in the financial service sector. I don't necessarily believe that's the case, but just the fact that that's being considered, that could slow down a little bit. The other thing that you have is you have a number of buildings in Manhattan right now, good quality buildings, that have capital structures that have taken them out of the market, that they really can't be competitive to lease. And eventually those capital structures are going to be fixed. It may take a year, it may take 2 years, maybe 3 years, but the new capitalization is going to enable it to meet the market, as Joe said, and lease. And so you'll have then, I think, an addition of space coming onto the market that today is vacant, but really not in the market.
But, you know, prior to the show, you were saying to me, and I think we were all agreeing, that certain people, certain owners are going to have to put more capital. And a great example was earlier this year when, you know, it was nice that S.L. Green and the case, you know, refinanced 1515. Yeah, they refinanced it for $85 million less, and they had to come up with the $85 million.
Right.
So that situation is going to happen because certain buildings have been over-leveraged over a period of time.
But what I'm suggesting is there's certain buildings that are over-leveraged right now that are zombie buildings, buildings that are in the market. They were 95% leased, now they're 80% leased, now they may be 85, 70, and until they actually have a capital structure that there's an equity investor, the guy who owns it at the end is incented to put new money in, they're going to continue to go down.
I
in
mean,
occupancy.
we can even go directly downtown. You know, we can go to 70 Pine. I mean, you have the two AIG buildings, you know, maybe one will be a condo. I did a show last year. But, you know, these are two buildings, you know, with old floor plates, you know, old utilities. It doesn't, you know, it's not modern buildings like 180 Maiden Lane, New York buildings over there. You know, that have one day, the day of reckoning is going to come. Who's going to pay for this over there?
Right.
You know, there's a circumstance.
But I think what Scott's alluded to is spot on in that we have had the well-capitalized REITs, the well-capitalized owners have had a competitive advantage in New York and across the country because as the need for concessions went up significantly, businesses were capital constrained. We were able to frankly stroke the check to get those tenants.
The broker said, I want to be certain that I'm going to get paid the commission.
Right.
And you were going to the established families, you're going to the well-capitalized REITs or the funds, and you're going to get paid, as opposed to someone over there saying, hey, where's he going to get the money for the tenant improvements? Where is he going to get the money to pay me the brokerage commission? I have a great story. There was a major investor who sold his business, was acquired by a publicly held company, and he was retiring and he wanted office space. And he shopped, and I gave him some advice, and he was ready to sign a lease at 1330 Avenue of the Americas. This is before the problems with Maclow, and he calls me up and he says, I'm ready to sign the lease. I've even met with Harry, I met with Billy, they were all committed, and I said, it's up to you. I don't know if they can own the building.
Right.
Yeah.
And it was the circumstance. And he moved somewhere else because he found an established owner. It wasn't the same type of building, but that's the circumstance. We were also talking before about bricks and buying properties. You had looked at, we all spoke about 685 3rd Avenue.
Right.
Now, you bought 340 Madison this year. 685 is not a 340 Madison. 340 Madison is a different building. The old building at 340 Madison, I still remember, was an ugly floor place.
Don't end with that.
No, that's I said the old.
Remember what Joe said? Beautiful. That's
No,
right.
it is.
It was a good buy, is what it was.
But what I'm trying to say is, what I'm really saying is, people always say, the land is worth this, the building is worth this. What are buildings worth? What is 1330 Avenue of the Americas worth? What is 111 8th Avenue worth? You could buy it. You could buy it. Everyone sitting here could buy it. But
We talked a lot about this before, and it's looking at your capital and the returns that your capital requires, and the disconnect in New York right now is things that you think should price opportunistically or in the value-added world or pricing like core, and so you're taking leasing risk. And Scott, you made the point before, people are just blowing right through that leasing risk, and they're paying up for it. So. People that own real estate right now, I think we're all looking at our portfolio saying, where does it make sense maybe to be a seller, which is why we sold 125 Park. And on the buy side, we keep hoping that you'll find the situation.
Somebody could have bought 510 Madison.
Mm-hmm.
Everyone sitting here had an opportunity to buy 510 Madison. And, you had 510 Madison and you had 545 Madison. Mm-hmm. And 545 Madison really hasn't leased. It's a different type of building, even though they've done a smaller floor plate. Now, I passed 510 Madison recently, the same way I looked at all your properties today on my walk here. 510 Madison, Boston Properties is going to lease that building. Mm-hmm. People are going to want to go into a Boston Properties building. It's going to be a boutique. It's like Joe said, there'll be some people on the top floor who will pay the rent. But what is something worth? People, everybody wants to own New York City. It's the best place. Washington, D.C. also. Right. Okay? They really want to own it. What are we going to see prices like what 650 Madison went for?
Well, here's an interesting point. If you look in D.C., if you start there, because I think the capital markets activity really started in D.C. They had some $800 square foot trades starting last year.
Right,
We had
and
a
then you
couple
had
more this year. Right, and those are the peak of the market. We're
Partly
going,
due to deal size, I think, when the
Exactly.
market was uncomfortable with large deal, Washington
Right.
was where the money.
And cap rates have dropped. We just sold one last week on Pennsylvania Avenue at a sub-5 cap rate. You guys have a building in the market that's going to hit close to $900 a square foot, only limited by a purchase option that a tenant has, is my guess. So I think you're going to see that starting to translate here to New York. I wouldn't be surprised if we saw prices north of $1,000 a square foot, because we have plenty of buildings that have $100 plus square foot rents in them. So if anybody wants to sell one of those, you take a $70 net rent and you cap it at a 5.
Okay, but the bigger question, and Scott brought it up, prior to the show, is the CMBS market, the collateralized mortgage-backed securities, is back, but it's not backed as aggressive as in the past. So if you're buying a building, you still need equity. Right. You can't go in there with 10%, and banks who are lending, the portfolio lenders and the CMBS lenders, are lending not on the future.
Right.
They're lending on what the rents are today. Don't tell me it's going to be worth $120 a
Present
square
cash.
foot.
But there's a lot of equity out there. There's been a lot of equity raised, or either people that think now is the right time to get into real estate that had not been in real estate before, or folks that are just
So when is Shorenstein 10 Fund coming up?
April of next year. We've got another $1 billion.
But you know, the other thing that you got to also look at, and we're having a little bit of discussion, is not every building's the same, right? I mean, when you take 510 Madison, so BXP paid, what, $900 a foot for a vacant building, again, not discounting for the risk, with an assumption they will get at least, which they will get at least. Whether or not they hit all their rents, we'll see, but they'll get at least. It's a good market, good timing to do it, but it's a trophy asset. And so as Joe made the point before about $200 a foot rent, there's also a subset of buildings that will be $1,200 a foot buildings, and there'll be a subset of buildings that will be $800 a foot buildings, and there'll be a subset that's $500 to $600.
It's like my 70 Pine. It's never going to be a $600 building.
Right.
You know?
Right. And everyone's trying to sort of try and set the perfect comp, but there is no perfect comp right now as to where values are, and it seems to be falling into a few different buckets. Our projection would be that the core assets, the cap rates continue to compress and go down. That when you look at the debt markets are improving by the week for quality assets. It'll be bifurcated, but core will clearly be on the right side of the ledger. When you look at the return premium against other vehicles, whether these investors are holding bonds or holding T-bills, if they get a 7% unlevered, stronger levered, clearly that's a nice premium for a well-leased, credit rent roll. The interesting thing is in some of these other opportunities where other pockets of capital come in, where there's more and more leasing risk, and I think those will continue to be all over the map. Your point before, Michael, is replacement cost is a good metric. It's one we consider, but we don't. Our capital partners and we tend to be a little more disciplined in that in a number of areas. So it's it's just purely underwriting how much you can lift the rent roll on those situations and exit if you need.
You know, you've never really invested in Lower Manhattan. Joe has always been committed to Lower Manhattan, and Brookfield, there's no question, is Lower Manhattan. And I'm not sure when...
I had Lower Manhattan. I sold everything in Lower Manhattan in 03, 04, 05, 07, before even 07, 05,
And as Mike
07.
Fascitelli has said on my show, I've never liked Lower Manhattan.
I've always been scared of it.
You know, there's been this question over there. You know, and Vornado is a great company. You know, Mike said, we don't want Lower Manhattan. We have the new trade center. We have the situation. How do you see what's happening in Lower Manhattan?
Michael, we are involved in more than 5 million square feet in Lower Manhattan. And between residential for rent, residential for sale, hotel, and office
Not
space.
a hotel, a fantastic hotel, the
Thank
UW.
you. Thank you. And so our history and our romance with downtown Manhattan goes for a long time. I remember Mayor Giuliani when he did the revitalization of downtown Manhattan. So we go back a long time. To the people such as myself, Brookfield, and other long-time owners of downtown Manhattan, there's a sentiment. We've been through it, through thick and thin. I think once again today, I am very, very happy at where we are in downtown. I am very happy to tell you that between thousands of apartments, I would not have more than a handful today available for rent. Our offices, our office space buildings are way below the average vacancy known by the brokerage firms downtown. They are saying 9% landlord vacancy plus 3 or 4% sublet, and totally 12, 13. Ours is nearly half of that. And you know, if you're there for a long time, if you are friends for years and years with your tenants, with the brokerage community, with your banks, your partners, I think downtown is a great little New York within New York.
I'm even going to make it a little better. I believe, as I said to everyone prior to the show about Hudson Square becoming a media center,
Yeah.
I think if Condé Nast goes downtown,
Transformational.
okay,
use, right,
and you
no
know
doubt.
the Daily News is downtown. You know
Different
they've
world.
moved. You can have a media center in downtown,
Yes.
and there is no question with the amount of residential apartments. I mean, the Whole Foods. You know, there is a different case,
parks and
and
views.
it's my new joke, and I wrote an article about it. Is Dwayne Reed now is a convenience store. they're opening up stores which are 15 to 20,000 square feet, where they have 40% grocery. So that is providing a change in downtown.
Right. Some
No
of the
doubt.
best stores are downtown, the Duane Reads.
We're excited for a number of reasons. Well, obviously, we'll have a slightly biased view given our holdings down there, and we would prefer if the competition stayed clear for a little while. But there's really three things that we're particularly excited about. One is the transportation infrastructure. The rest of the country is struggling with budget issues, and we were fortunate to actually get federal and state funds at the right time, and we're going to have the best transportation hub and infrastructure in the country, and it'll be the most modern, clearly. So I think, and that is starting to grab hold. I think it was tougher for people to visualize. Now they can see that coming out of the ground. The other important thing is when you look long term over Manhattan stock inventory, we've added 6 million square feet of new stock net over 2 decades. We're about to get 10 million plus just in one small corridor, plus we are making a sizable investment in the World Financial Center. Still, we obviously consider it to be trophy, but we want to add and make more of an investment in the common areas and keep it up to standards from a LEED standpoint. I think that corridor should be pricing closer to Midtown core than it has historically, and I think these things will help grab. And residential is the other. Clearly, the residential neighborhoods in Manhattan have gravitated south, and Tribeca and Soho have become the hot neighborhoods.
I mean, nobody wants to be on the Upper East Side. I mean, when I've done residential shows, and then people said, "Oh no, I can talk about Tribeca, I can talk about downtown, I can talk Upper East Side." Nah, nobody wants to rent there. I still have to give concessions over there on the Upper East Side. It's a different case. So
it's come a long way. There's no doubt. I mean, the numbers are showing it, but also just your point. Majority of our tours now, the senior managing partner has a loft in Tribeca as opposed to an apartment up on their Upper East Side, and that wasn't the case 10 years ago.
No, that makes sense.
The politics are out of downtown, Michael. That's the best thing. And now that the politics are out of downtown, it's all about development, it's all about occupancy, all about the memorial being completed. And everybody, in fact, if you go to the ground zero, you see a couple of thousand people working, bringing great energy to downtown.
I think
it's great.
I think in summation, New York City and the suburbs are getting better. The resiliency, the city is the city. This is the Mecca. This is the financial, the media, and everything else. And to have the four of you in a half an hour is insufficient time. So we're going to have you come back later on in the season. I'd like to thank Scott Reckler, Dennis Friedlich, Mark Portner, and Joe Moynihan. See you next week.
Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Joffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.